Hi, this is John Lux of AskLux.com and reverse-merger.info. I wanted to describe to you, and I think you'll find it to be very enlightening, what happens when your new issue trades in the aftermarket. It's a process that not many people understand, and the only way to understand it is to sit on the desk and do it. The period that I'm going to refer to, I was Vice President of Trading for a regional underwriting house, a New York-based underwriting house. And in the 1980s, we did $5 and $10 million firm commitment deals. In other words, we bought all the stock before reselling it to investors. We had capital at risk. And generally, those issues that we did were high-tech companies of some kind. We did a lot of biotech companies. We had a very famous figure running our underwriting department. He had done something like 170 underwritings in his lifetime, and he would get a lot of deals from major firms that didn't want to do the deals themselves because they were too small, and they wanted to outsource them. So we wound up with some very nice deals. Now, basically, what you do if you're trading the stock, the first thing you have to decide is how much stock, if any, to go short. We knew that we were going to have to support the aftermarket. We knew that the bears, the shorts, the hedge funds are going to be selling that stock like crazy, trying to drive it down, trying to make a fast buck on driving the stock down and causing us trouble. So what we would do, we would go short anywhere from zero, which was very rare, but usually about 10% of the stock we were selling, or maybe even as much as 20% of the stock we're selling if we thought it was going to be a weak issue. And we know that from the indications. When you're an underwriting house, you take indications of interest from other firms. Now, we had 42 regional firms that participated in our deals, and we participated in their deals. So I had a lot of new issues to trade. And these regional houses were mostly New York Stock Exchange firms that were regional in nature. So, for example, in Florida, where I'm located now, we had Raymond James and some of the other names that are well known to investors in this area. At any rate, we would go short a bunch of the stock, and then when the stock is effective and we had confirmed all of the indications, in other words, we had a firm commitment from all of our syndicate partners on how much stock they would take, we would release the stock for trading, and then all hell would break loose. The stock would fluctuate 10-20% in the first day very easily. There would be massive amounts of stock traded in the first couple of days. Probably, as a general rule, in the first couple of days of trading, we would trade more stock than we would trade in the next 2-3 months put together. As you say, there'd be a lot of hedge funds and a lot of speculators. There were people who were not able to buy the stock at the issue price, wanting to tie it down, so they'd go into the market and buy stock. We had to balance out all these imbalances in supply and demand. So the trading was very hectic. On one occasion, our syndicate department forgot to confirm somehow the indications, and the issues started trading without the other brokers being committed to buy the stock. So we had to eat practically the whole issue, and it almost put the firm out of business. Being an underwriter is an ultra-hazardous activity. Now, when you select your underwriter, you want to make sure that this company is going to be around long enough to do your deal. And the aftermarket trading, you had better leave to a seasoned professional. So for more information on all this, you can call me, or you can go to my websites, AskLux.com or reverse-merger.info. See you there.